Welcome to today's Capital Markets Series event on private equity, hosted by CFA Society Chicago's Education Seminars Advisory Group. This is the seventh part of our Capital Markets Series. Replays of the previous events are available on the Society's YouTube channel, and recaps are available on the Society's blog. Information on all upcoming events can be found on the Society's website at www.cfachicago.org. Today's discussion will be moderated by Christian Barron. Christian is currently an associate at Cave Creek Capital Management and focuses on deal origination, evaluation, and execution across consumer, industrial, business, and healthcare service industries. Joining Christian for today's discussion are Mike Holtz, consultant at Asset Consulting Group, Patricia Lumscombe, Managing Director at Lincoln International, Casey Swerchek, partner at Alterna Equity Partners. I will now turn it over to our moderator, Christian.
Hello, everyone. Welcome to the CFA Society Chicago Capital Market Series. This will be the seventh event of the series and focusing on private equity. As Chris mentioned, I am your moderator today, and I will be moderating the discussion amongst three experts, Mike Holtz, Patricia Lumscombe, and Casey Swerchek on the topic of private equity and the asset class as a whole. I'm also with Cave Creek Capital Management, a lower middle market private equity firm that participates in healthcare services, business services, consumer products, and niche manufacturing industries. With that being said, I will turn it over to Mike Holtz to introduce himself.
Hi, everyone. I'm Mike Holtz. I'm a director at Asset Consulting Group. We're an investment consulting firm based in St. Louis, Missouri. We work with about 150 clients, advise about 150 billion in assets. And our clients range from family offices to public pension plans to foundations, endowments, and some insurance clients as well. I started my career at ACG in 2010 and spent the first 7.5 years in the private equity and real estate research group. And I've since transitioned to our consulting team, and now I work with our family office clients. Casey?
Sure. Casey Swerchek, great to meet everybody. Alterna Equity Partners, we're a lower middle market private equity firm focused on control investments in companies that are anywhere from typically $20 to $150 million enterprise value businesses from an EBITDA perspective, kind of 2 to 15 million in size. Again, predominantly taking control positions, but in a partnership-oriented approach where we like to partner with management teams and owners that are owning a significant stake on the other side of our transaction, rolling a meaningful amount of their proceeds back into the deal. We're based in South Florida and looking at opportunities nationally, actually closing on our first transaction today in an hour. So the whole background is in private equity and a mix of family office and institutional. I was with a couple of larger consulting firms similar to Mike and Wilshire Associates and Hamilton Lane, and then spent the last 7 to 8 years before forming Alterna at another lower middle market PE group.
Great, and I'll just jump in here. Hi, I'm Patricia Lumscombe, and I'm a managing director. I'm actually co-head of Lincoln International's Valuations and Opinions Group. And I've been with Lincoln coming up on 15 years. I'm based here in Chicago, so I'm looking out at about a foot of snow that we've gotten over the last day. But for those of you who are not familiar with Lincoln, we're a global investment banking advisory firm, close to 800 employees, 22 offices all over the world. Our three primary activities are M&A. I'd say a lot of that is sell-side M&A, and a big part of that M&A relates to private equity. Last year in 2021, we closed over 400 transactions. Our second area is capital advisory. So we raise financing for a lot of the private equity backed buyouts, dividend recaps, and the like. And then the third area, is our group, Valuations and Opinions, and we work with about 125 alternative asset managers and value 3,000 portfolio companies of private equity quarterly. So quite an active group, and we also provide fairness and transaction opinions. So just want to say thank you, and happy to be here today and look forward to the panel.
Definitely. Thanks so much, guys. So we will flip it over to our presentation so that you guys do have some data to reference as we discuss the panel. Let me put this on presentation mode. Well, once again, thanks again for joining. The first slide will be just kind of an overview of the private equity asset class. And the first question will be directed towards Mike. Just a quick question: why has the private equity asset class outperformed other asset classes?
Yeah, so I think there's a couple of different answers there. One, private equity is a pretty inefficient asset class. When you think about companies that are private, you know, by their very nature, they're not publishing public financial statements. There's a lot less information known on these companies. And so when we look at various investment strategies on the private equity side and on the public equity side too, generally the less efficient asset classes have the greatest opportunity to outperform. So, you know, when we look at large cap US equities, active management there over a long period of time does not add that much value, or it's much, much harder. On the private equity side, which is much, much less transparent, information is harder to get. You have to do a lot more legwork to come up with valuations of underlying companies. There's a tremendous value creation opportunity there. I think another reason too is you look at this historically. You know, 20 years ago, 25 years ago, companies went public a lot sooner than they do today. So think about Amazon. Amazon went public in 1996 at a market cap of $400 million. Today, companies are staying private much longer. So 20 years ago, the median age of a company that IPO'd was about 6 years. Today, it's closer to about 9 or 10. And so what that means is that a lot of the value that, you know, from the year 2000 to 2010, a lot of the value creation that was created to public equity investors over that decade, now it's being earned by private investors. And so think about Uber. Uber went public in 2019 at, you know, a 75 billion plus valuation. And so, you know, a lot more of the value creation is happening in private markets today than happened historically.
Definitely. We appreciate that overview. And then to go into it a little bit detailed, Casey, if you could kind of discuss as to what strategy Alterna employs, that would be much appreciated.
Yeah, sure. So we're focused again on within this chart, it'd be more the buyout and growth end of the spectrum. So our investments are control investments. We're typically looking to buy, you know, 51% or greater. More like 60 to 70% equity ownership for our fund on the other end of the transaction, with, again, management and or the team owning the balance. And we focus specifically on an end of the size spectrum. Private equity gets used as sort of a generic term sometimes, and there's very different strategies, approaches, and returns associated with different segments of the market. We tend to focus on the smaller end of the spectrum. That, to Mike's point, is probably even more inefficient than larger deals further up market, where there's a robust market of intermediaries that take those companies to market and run auction processes. Our deals tend to be more proprietary and direct relationships with the founders, which we hope usually results in a slightly more attractive entry point and valuation for the businesses that we're buying. But you know, overall, our end of the spectrum, I think, you know, the biggest piece for me, that as it relates to our strategy and where that manifests itself on this chart, you know, IRR is certainly one great metric for measuring returns in the asset class. There's another metric that we focus on, which is cash on cash return, right? So for every dollar we put in, what's the multiple of that dollar we're getting back? You know, at our end of the size spectrum, I think it's actually, you're seeing compressing hold periods. So we're trying to invest in these businesses and then trade out in, you know, a typical private equity answer would be 4 to 6 years, right? We're starting to average more 3 to 4 years in our holds at the smaller end of the spectrum. And, you know, we kind of underwrite our deals to a 3x cash on cash return, which the shorter the hold, the higher the IRR as well. So, you know, that's something that I think is different than when you look at the upper end of the size spectrum, where the hold periods are actually getting longer, right? In the large cap space, private equity holds are averaging these days more 6.5, 7 years, right? You see fund managers raising much longer dated investment vehicles because it takes a long time to turn a battleship than the micro machine that we're dealing with.
Definitely. We can touch on the middle market and lower middle market that later, but one other thing I wanted to touch on before moving into the next slide is, if Patricia, if you could provide some more detail on the difference between buyout investing and growth investing, that would be much appreciated.
Yeah, absolutely. So, we always think of growth investments, involve really providing equity capital for a company to achieve its strategic business plan. It's providing them capital to expand the business. Growth investors are typically minority investors. They're not control investors, and because of this, they don't really have the ultimate say, in how the company is run. And therefore, they're obviously, because of that lack of final say, willing to invest at probably a discount to what a control buyout price would be. The buyout investor, you can choose the timing of the exit. You can, think about how to make changes within the company to maximize returns, implementing revenue, cost saving strategies, just to enhance the overall value. The growth investor doesn't really have that option. So as I mentioned, you typically do see a discount in that growth value entry point from a control value, and we always think it should be, that discount should be somewhere in the 20 to 25% range.
Definitely. And then maybe one thing we could touch on before moving on to the next slide. This question is probably best for both Casey and Patricia here. What's the difference in structure between a growth investment and a buyout investment? If you could touch on that, I think that would be helpful for our viewers.
Yeah, happy to. I'll give kind of my high level, and Patricia, happy to see how yours differs. But typically a growth investment is going to be, to Patricia's point, an unlevered investment. So you're investing equity into the business. There may be some level of preferred return that's associated with that. So that could be either convertible preferred or a participating preferred structure. But it's usually all equity, and it's usually without the benefit of leverage. And in a control deal, typically we are levering our equity, right? So if we're buying a business for, call it roughly 6 times, we're looking to put 3 turns of leverage on that business, and then our equity sits behind that leverage, that third-party leverage.
Yeah, and I was just going to add, kind of on the governance front of that, for control, you're obviously going to see the control buyer, the private equity firm, have the majority of the board seats, really in the driver position. On a minority kind of growth equity situation, you maybe have 1 representation on the board, or possibly 2, but you may not be, or likely not be the ultimate decision maker. You'll have some influence, but not the ultimate decision maker.
Definitely. Well, on to our next slide, which this slide is actually ACG's expectations for each asset class going forward. And once again, private equity here is expected to be the highest return. And if Mike, if you could kind of elaborate onto which strategy have you seen perform best, and which strategies do you expect to continue this performance going into the future?
Yeah, sure thing, Christian. And so a couple of items about this slide. One, so this is our intermediate term capital market assumption. So we essentially developed 2 sets of assumptions. One is our intermediate term, which is our next 10-year expectations for returns, and then we have a longer term 30-year return expectations, which when we do asset allocation models for a longer period of time, we have a different set of returns for that time frame. So the way that we build private equity programs for our clients, we like to have exposure to a lot of different sectors within private equity. So we like to have buyout exposure, lower middle market, middle market, mega buyout, and then we also like to have some distressed investing as well. Another area is venture capital. So typically in venture capital, you're investing in companies at a very, very early stage Sometimes they're not even generating revenue, and most times they're not profitable companies. And so when we look at historical returns for private equity, you know, and we use PitchBook, that's our private equity data provider. It's sort of like a Morningstar you can think about, but for private equity and private real estate. When we look at the returns out of PitchBook, basically for the last decade, venture capital has been the best performing private equity asset class. So going back to 2010, up until about 2 years ago, really, it depends on the vintage year, but the median return for a venture strategy, so the 50th percentile return for a venture strategy, ranged between about 20% on the low end and about 36% on the high end. So venture has had a very, very good run for the last decade. Our clients like venture, we like venture as well. But again, venture, when you look at that as a percentage of the total market opportunity within private equity, it's probably about 20% of the total private equity market opportunity. And so on the other strategies within private equity, we have a lot of clients who invest in buyout as well. And in buyout, you know, in Casey and Patricia can attest to this as well, you're typically buying more mature companies. And so that has a couple of implications. One, generally, you're not going to experience the type of upside returns that you'll see in a venture strategy, the potential. And so if you think about like an early investor in Uber, you know, they made over 500 times their money on an early stage investment in Uber. On a buyout strategy, you're typically buying more mature companies, and they're not going to have the same level of growth profile most often as a venture investment will. And so your return profile is going to be the higher end of your return profile is going to be lower than it would be for venture, but you're still going to have, you know, we still expect 15-16% net returns out of the buyout side as well. And so one of the things that we're very cognizant of is maintaining diversification within a private equity portfolio. You know, I mentioned that the last decade really has been highlighted by the strong performance of venture capital funds. You know, that's not too different from what we saw in the mid to late 90s. And then you had the dot-com bubble crash, and venture was the worst performing private equity asset class for the next 5 years. Buyout did much, much better. Then you had the global financial crisis, a lot of leverage in the system, buyout funds did worse. And so, you know, we're always trying to work with clients to not just focus on what has been the best performing asset class or the subsector for the last, you know, 3, 4, 5 years, and just acknowledge that there's going to be different market environments where venture is going to outperform better than buyout and buyout is going to outperform better than venture. And we want to have exposure to all the sectors within private equity.
Definitely. And then if you could kind of elaborate on to what your expectations are going forward, that would be much appreciated.
Yeah, so, you know, for the next 10 years, this is sort of our median return, which is about a 10.5%. And this is for private equity. This is all encompassing. So this would be buyout, venture, everything. And there's a couple of reasons for that. And you'll see this in some of our public equity assumptions as well. You know, large cap equity right now for the next decade, we're looking at, you know, sort of a 6.5% annualized return. If you look at the last 10 years, you know, it's well north of 13-14%. And so, you know, the returns that we've experienced in the public market over the last 5-10 years are not likely to be experienced on a go-forward basis for the next 5 to 10 years. And it's kind of translated, it's a similar thought process as it relates to private equity. So although, you know, 10.5% is the median return, we think we can add value by picking good managers that can outperform that. You know, we don't think that the median return for private equity is going to be 15-20% for the next 10 years. Like it has been for the last 5 years. Definitely.
And then on to our next slide here. This is a slide of the U.S. buyout versus the Russell 200, 2000, and the S&P 500, as well as different valuations and leverage multiples on here below in regards to size of business by enterprise value. The next question is directed towards Mike again. If you could kind of elaborate as to why private equity assets receive a valuation discount versus public assets, that would be much appreciated.
Yeah, so a couple of factors here. One, and Patricia, I'm sure can expand on this as well. Typically, because private equity is illiquid, if you had the same company that was being purchased in the private markets versus in the public market, there's about a 20-25% discount, just an illiquidity discount for being private. One of the other factors too to consider is that there is less transparency in private equity than there is in public equity, and so if you think about buying a house, if you had two options to buy the house, one, you had to drive by and just take a look at it from the outside and put in an offer price. The second alternative is to actually go in the house, get an inspector to come in, look at the monthly utility bills. You'd have a much better understanding of what that asset is worth. And so if you're private and you have less information, just in general, you're probably going to have a lower valuation, a lower multiple that you would pay for that asset than you would if it was public. Another factor is just in general, public companies are much larger than private companies in general. And so with public companies, you're a lot more efficient. You have a lot more corporate governance in place. You have typically a very seasoned management team. They understand how to communicate with investors. On the private side, typically companies at the smaller end of the market, the lower your EBITDA is, generally, and it depends by industry, but generally buyers are going to pay a lower multiple for that. So those are a couple of the reasons why you see a valuation discount between public and private equity.
Mm-hmm. And then Patricia, if you could kind of elaborate as to why smaller companies with lower cash flow or EBITDA have lower valuations on a multiple basis versus their larger peers, that would be much appreciated.
Yeah, no, absolutely. And a lot of great points you already made kind of between the public valuations and the private company valuations. But as you can see on that lower chart, there's a disparity even between larger, what we call upper middle market and lower middle market companies. You can see that for multiples for less than $250 million enterprise values, looking at this chart, somewhere between, let's call it 6 and 8 times. And it's kind of a modest progression upward over the years. But interestingly, if you look at the larger businesses, those with enterprise values greater than 250 million, you'll see that there's been even a greater, I think, climb in enterprise value. And that's really consistent with what we've seen here in our own valuation activities, that actually multiples in general right now are really higher across the board than they ever have been. I want to say it's somewhere between 1 and 2 times 2 turns of EBITDA that multiples are higher. So overall, there's been just kind of a climb in multiples. You can see that climb a little bit less for smaller companies. The reason being that with smaller companies, there's just simply greater risk, at the end of the day. You touched on, just the lack of kind of diversity in terms of, customers, in terms of products. Oftentimes for smaller businesses, if you lose one customer for a smaller business, it's going to have a much more, negative impacting on value than a larger company that's much more diversified. The other thing we oftentimes see is just the depth of the management team, kind of that whole succession, of the continuation of management of a smaller business. Oftentimes is not as robust as it is with a larger business, just with a more broader based management team. The other item is we talked about a little bit is just liquidity. Smaller companies, they don't have that liquidity buffer. And we saw that loud and clear during kind of the trough of COVID, the March of 2020, June of 2020, you have all of this, the government help for these small businesses. And oftentimes we saw a lot of sponsors have to put in money, equity infusions into more so to smaller businesses than to larger businesses that were more diversified. And also just looking at who, buyers potentially interested in a small business versus a large business. We think that probably the buyer pool potentially for a smaller company could be a little bit more narrow, because if you think about a lot of these big strategics, big public companies, they're so big that to buy a lower, kind of smaller enterprise value company, lower middle market, isn't going to move the needle, in terms of kind of their public markets, how investors view them. So oftentimes the buyer pool for smaller businesses is not as robust as it is for larger middle market. So lots of reasons why smaller businesses trade at lower multiples than larger businesses.
Definitely. Thank you so much. And then this next slide, it kind of shows the differences between large corporates, middle market, and lower middle market. But my next question and the next subject of conversation will be directed at Casey here. First of all, what's your definition of the lower middle market? And why does Alterna decide to focus on the lower middle market versus other strategies?
Yeah, well, first off, I don't know that I've ever met two people that define it exactly the same way. So it's sort of a loose definition, right? But I think what you have on the screen here is about as good approximation as any, right? I like to think of our sweet spot as kind of 10 to 100 million of revenue. And there's a lot of businesses at this end of the size spectrum that, to the points that Patricia made, Mike made, there's a lot more risk at this end of the spectrum. What we tend to find when we're investing, we're the first outside capital on the balance sheet of these companies, right? They've never had an outside investor. More often than not, the founder is still actively involved, engaged in the business. And so, they've grown the business to a point, and they're looking to a lot of times they've already identified multiple ways to double, triple the size of that business. But at the end of the day, they can't think about the risk that they're taking the right way because their balance sheet is irrevocably tied to the ownership of that business. And so this end of the size spectrum, there's a ton of opportunity in our view in terms of the size of the market. It's arguably the largest segment of the U.S. economy in terms of total number of companies. But you got to kiss a lot of frogs to all the points that, again, Patricia and Mike made. Again, our fund is making its first investment today, 6 months in. We've looked at 300 deals to get to that one opportunity. It's got to be the right combination of factors to sort of overcome some of the deficiencies at this end of the spectrum. And I think the opportunity is that you're buying at the valuations you had on the prior page on the left-hand side. Hopefully with our help, our strategic guidance, our value add of supporting these management teams to help them institutionalize the business, we're exiting at the valuations on the right-hand side of the page. It's very hard to financially engineer your returns at this end of the spectrum. You have to do it almost entirely through operational value add.
And then one thing, maybe you could kind of elaborate on this. Why is it that lower middle market businesses have much more key man risk per se than your traditional middle market business? What is it about the founders or the ownership or just the structure of the company that may alter that risk return profile?
Well, again, to some of the points, I'll answer from my perspective to some of the points that, because we live it every day, some of the points that were already made, that founder is not just the founder, he or she is the CFO, is probably the top salesperson, has all the key supply chain relationships, and may or may not also be the head of HR. So you don't have. That's not to say there's not robust management teams at this end of the size spectrum. More often than not, what we find is they're deficient from a finance and accounting perspective. These smaller businesses that are family owned. On average, our companies that we're tracking are 20, 25 years in operations, right? And for a variety of reasons, the last part to get built out is almost always finance and accounting, right? There's sort of a glorified controller in place. There's no CFO in the business, certainly not one that thinks more strategically, very little in the way of the system of KPIs, or there's no ERP system. They're probably cash basis of accounting, not accrual. But at the end of the day, I'm naming a lot of things that to us are low-hanging fruit, right? Those are things that we feel like we can go out and implement change very, very quickly. When you get to the bigger end of this pie chart, much more robust management teams, a lot more of kind of that operational value has been, the juice has been squeezed out of those lemons, so to speak. Maybe they're oranges, I don't know. But at our end of the spectrum, there's a lot of meat on the bone for things that you can do to right size these teams. And I think the next level up of buyer, strategic or financial, will pay a premium for that if you've done it correctly.
Yeah, and just to kind of touch on, elaborate on what Casey said too. Before I joined Asset Consulting Group, I spent about 4.5 years at KPMG in their transaction services group. So we were typically hired by private equity funds when they were going to buy a company, and we would meet with the management team, look at SKU level, profitability, margins by product type, etc. And there's a lot of times where we'd be looking at companies that were $25 million in sales, $5 million in EBITDA, still using QuickBooks. And when you went down and you talked in detail about product line profitability, SKU level profitability, we'd be going to these meetings and talking to the CFO and saying, about profitability trends. And this is really the first time they had seen the analysis done. And so to Casey's point, a lot of it's just bringing data to them that's synthesized, building out the accounting and finance function to show them, look, if you just focus on this product line right here, or these types of customers, your margin can go from 15% to 18% pretty quickly. So that's sort of some of the low-hanging fruit that Casey touched on as well.
Yeah, and I think it's part of, to Mike's point, it's one of the reasons that we love this end of the spectrum as well, is that, as you have those conversations with founders who, again, usually own the lion's share, if not all, of the business, at that point you're having the discussion, the light bulb goes off, and they see, kind of that the path, the runway starts to light up in front of them in terms of how they can meaningfully grow the business. Again, they've largely identified kind of where the runway is. They're just looking for the lights to be turned on to find it sometimes. You tend to find those founders want to they almost get re-engaged in the business through the process. And that's where, we love that model, because there's no better partner than the founder of the business, right? And to the extent they want to roll a meaningful amount alongside of us, it's great alignment for the upside.
And then before we go on to the next slide, maybe Casey, one more point there kind of touch on, how does alternative structure its deal to make sure that the founder stays engaged for like the next 5 years and might get a second bite at the apple?
There's a couple of ways you can do it. Again, our deals overall tend to be much lower leveraged and that's symptomatic of that. That's not alternative. That's just this end of the spectrum, right? Our industry multiples for 20 years in the sub, I don't know what it is, 50 million of enterprise value space is almost consistently 6 times, right? It's grown from maybe 6 to 6.5, right? And that's over a 20-year look. So leverage levels come in around a 50-50 cap structure. This first deal we're closing is actually even below 50. We're going to be about 60% equity, 40 on the debt side. So again, there's not a lot of financial engineering at this end of the size spectrum to generate your returns. And so typically what we're looking for at this end of the spectrum structurally is, the ways you generate that alignment is, again, that equity rollover. So as part of the proceeds, they're rolling equity back into the transaction. It's another way that we kind of try and protect ourselves from a valuation perspective. They're rolling equity in at the same value, right? And so that's another great alignment feature. But there's other ways you can do it, and we've certainly participated, had management participate. Maybe the next level down of management is participating in some sort of option pool. Typically, a lot of these companies, again, management doesn't own anything in the business. It's amazing to see how quickly things change operationally when all of a sudden there's a 10% option pool on the table. Then the last thing I'd say is sometimes there's a promote at the management level. So based on a cash on cash threshold that's met for us from a return perspective to our hard dollar cost or investment in the business, then every incremental dollar over that, there's kind of a split between management and the equity group. But at that point in time, we're north of hopefully a 3x cash on cash return, and everybody's happy.
Definitely. The next slide here is just a little industry analysis. It's separating each industry by valuation multiples, and also what's not shaded below here is the leverage multiples. So the next question is to Patricia: why does tech and healthcare earn the highest valuation, and what is so attractive about these sectors?
Yeah. So interesting, even before COVID, both tech and healthcare were experienced favorable macro dynamics. High growth industries, tech, obviously the beneficiary of just the continued digitalization in all aspects of our lives, everything we do. Healthcare, aging population, and just that related increase in need for healthcare services. But you add on top of that, both of those industries have been beneficiaries actually of COVID. Tech, needless to say, remote work environment, the focus on SaaS now, recurring revenue technology companies is really a hot sector. We've seen multiples of recurring revenue climb tremendously throughout kind of this whole COVID period that we've been in. On average, we track this in our team. They're up over 3 turns from kind of south of 5 times of recurring revenue a few years ago, now somewhere between 5 and 10 times for recurring revenue companies. Healthcare, kind of the same story. Obviously, they benefited during COVID from, being, if they're a healthcare supplier, they benefited. But where we've also seen it are what we would call our, healthcare service areas, kind of that elective care, dentists, dermatologists, outpatient surgery. There was a little bit of a slowdown in demand during the trough of COVID, but since that point in time, demand for these businesses has come on strong. And in particular with kind of healthcare elective services, they're highly fragmented industries. So we've seen a lot of roll up, a lot of tuck-in acquisition activity. So that, with the sponsors buying the tuck-ins at low multiples, adding in the EBITDA, making certain cost savings to the tuck-in, and now it's on the platform multiple. And so they're getting a huge amount of multiple accretion from the whole consolidation play of a very fragmented sector, within healthcare.
Definitely.
So those are some of the reasons.
One thing before we can kind of flip on, if you could kind of elaborate to our viewers why recurring revenue might be more attractive to a private equity firm, and particularly valuations, than lumpy revenues, and that would be much appreciated.
Yeah, no, absolutely. I mean, it makes perfect sense if you sign up a customer and, you've not have that customer for life, but you have them for a long time. They've got to sign long-term contracts. And so that obviously is going to provide more stability to the business. And, you can build upon that. So they become very scalable business models that if you can count on, revenues to occur year in and year out, and then continue to scale that, to some degree, you've got a home run on your hand in terms of value. So that's the reason. Versus, other industries that are more short-term project-based. A lot of suppliers to the government, for example, we see that once if a government closes down a program, then your revenue base can shrink pretty quickly, and so making recurring revenue quite important.
Definitely. And then I'm going to flip it over to Mike here. Why might what Patricia just mentioned out, and how recurring revenue, how you can count on a customer paying monthly revenues per month versus lumpy revenues, does that have any effect on why on valuation in regards to industrials, why industrials might be valued lower than a tech company? And also, what's your view on these industries going forward, and how are you allocating your clients' capital?
Yeah, so generally we invest with private equity funds who have for the most part, depends on the individual client, but we do a lot of diversified private equity funds. So they might have a team that focuses on business services and consumer. We do have some that have like exclusively technology focused sector strategies. And really it just depends, similar to what I was mentioning before about, different vintage years, different substrate within private equity, you're going to perform, better or worse. It's kind of similar to, at the sector level. And so if you look at energy, for example, if we would have looked at this chart, back in 2014, it probably would have been dramatically different. Energy is a very cyclical sector. And so with that cyclicality comes a lot of variability in ultimate returns for fund investors. And so we try to be, we're not trying to say, we think for the next 10 years, the tech sector is going to be the best private equity sector, so we're going to allocate client capital there. We try to take a more holistic approach and look at their overall private equity portfolio. And in general, we want to have exposure to all the different sectors, within reason.
Definitely. And then on to our next discussion. This will be catered towards Casey here. You kind of talk about as to how Alternative is able to source its deals, what that process looks like, and then we'll go from there.
Yeah, absolutely. So as I said, we're kind of, post our first close, we're sort of 7 months into this effort on the new fund, and we've looked at 300-ish deals to date. 80% of what we've seen thus far has been outside of traditional auction process. We absolutely participate in auctions, which an auction is usually a larger investment bank running a process and going out to a very wide universe of buyers, and that tends to create a bidding war. To Mike's point, prior comment on the house analogy, right? It's trying to buy that house just from driving past it, and as part of it, you see about 100 people on the front lawn that are all also bidding on the same house. We generally try and avoid those situations, right? Our approach has really to be methodical from a proprietary perspective. So we're affiliated with a large multifamily office that has the predominance of its client base is current former small business owners that have a huge network of not just deal flow, proprietary deal flow, but also value add that they can bring to bear in these deals. We have another affiliated business here that's a factoring group, which spends nothing but all day, every day working with lower middle market companies, more from a working capital receivables perspective. We now are the beneficiary of that business development effort. They're making 2,000 calls a year into the market, almost always to founders and CEOs of businesses. And so a component of that deal flow comes through a network, and then our own networks, right? We've been in this space for a long time as a team, and we've got a tremendous network in service providers, intermediaries at our end of the size spectrum. Because these companies are smaller, total enterprise value is smaller, you don't have the robust intermediated processes, because the fee opportunity for investment banks tends to be much smaller at this end of the spectrum. And so when we find a deal and it's represented by an attorney or an accountant, wealth managers, right? Sometimes wealth managers, first person to find out that there's a transaction that's about to happen, right? Because they're a very trusted advisor to the owner of that business. So we try and leverage our connectivity in those networks, as well as the broader alternative ecosystem.
And then if you could elaborate on the differences between a proprietary deal versus an auction deal, and why might a proprietary deal be a little bit more attractive than an auction deal, and kind of like the process of going out and finding a proprietary deal?
Time, that's probably the biggest difference. So in an investment bank process, things move very efficiently. The quality of earnings might already be done. The deal is really tied up with a nice bow on it, and great looking presentation attached that tells you what the business is. Our deals, when they're proprietary, none of that's available. So we're doing the quality of earnings. Sometimes we're doing desktop QV work where we're going in and analyzing the numbers ourselves. They're never what we started out the conversation thinking they were, right? At some point in time, we have to reevaluate the opportunity based on revised numbers and projections, because we're in there doing that work firsthand ourselves. And there's a longer gestation period for those proprietary deals as a result of that. It takes longer, but I think what you end up with on the other end is a much truer picture and understanding of what the business actually is. And most importantly, above all else, at this end of the size spectrum, you're backing teams, right? We're not taking sector bets or macro bets in the market. It certainly filters into our underwrite, but 10 out of 10 times we're backing management teams, right? And their ability to operate and execute on a model. Again, they're rolling meaningful equity stakes alongside of us. And so, this first deal we're closing, it's been 9 months in the work. If we don't know this management team at this point in time, we're never gonna. So I think versus in a banked process, it feels more like speed dating.
Definitely. And then the next topic I kind of want to cover. What are some, you talked about it earlier, Patricia. What are some of the considerations that go into valuation? You did mention it earlier, but maybe it might be helpful to touch on it more specifically here.
Yeah, well, I'd say, and we've touched on it a lot, just kind of the overall growth outlook of the business. You know, we talked about, you know, tech, healthcare services, business services. Right now, they're all, you know, most businesses in those sectors are high growth and therefore attracting premium valuations. You know, consumer, industrial right now, you know, we're seeing with a lot of those portfolio companies, they're more mature, to begin with, you know, particularly, you know, dealing with consumer staples, capital goods, but B, they've been a lot more impacted by inflationary pressures. And we're seeing for a lot of those businesses right now, particularly consumer, that, you know, their margins, because of inflation, you know, labor, supply chain shortages, margins are getting squeezed. And so all, you know, that, that growth, but then also that margin profitability, you know, and that's kind of, you know, every company's secret sauce, if you will, is their ability to have high profit margins. And so higher profit margins, again, lead to higher valuation levels. You know, we talked about a little bit about, you know, customer concentration. Obviously not good. You know, a lot of eggs in one basket with customers. You want to try to avoid that. Some industries it's impossible. You know, if you're selling to the big box retailers, selling to the big 3 or 4 automakers, you can't avoid that. And oftentimes you do see lower value multiples in those sectors. Capital intensity, another great one. You know, you have to manage that capital, whether it's, you know, plant facilities, heavy plant facilities, heavy PPE. You have to manage that extremely well because you got a lot of capital at play in sustaining, you know, the capital that's needed for the business. And then cyclical, we talked about that. You know, obviously cyclical industries in general, you know, tend to have lower multiples. You never know if when that cycle is going to turn on you. And we see, you know, private equity, you know, typically paying lower multiples for more cyclical industries. So all of that impacts value differentials.
Mm-hmm. And then before moving on to the next slide, I know we are a little bit short on time here, but Casey, if you could kind of elaborate on how Alterna seeks to grow equity value after an equity. You touched on it a little bit. What are some, like, what's the buy and build strategy? What are some of maybe organic de novo growth?
Yeah, so beyond what we already talked about, I'll mention kind of two approaches. You know, this deal closed in another under letter, two very different growth strategies post close. The first is buy and build. So we're buying today as a platform. It's in the digital marketing space, and our view of the world is that there's a very robust, talented management team here that we can layer a lot of revenue on top of. What we're looking to acquire are smaller agencies within this space that tend to have a handful of clients that are very sticky in long-term relationships, but they sub out a lot of the work because of the smaller nature of the business. And with us being a full service agency, we can strip out a lot of that cost on the other end and make the business even more cost efficient. And, you know, for those smaller businesses, we're even at a lower valuation in terms of the add-ons. So you typically you're buying the platform for X, you're trying to buy the add-ons for, let's call it, you know, 20-30% discount to X. And, you know, we've got a feature in our structure. So even though it's a low levered deal, we have a delayed draw term loan in place for the deal that we'll be able to flex based on our deal structure to go out and be very efficient from an equity perspective of deploying additional capital into the deal. That's all built on the concept of growing revenue, growing EBITDA, and, you know, this business trades on a multiple of that. So that's sort of, you know, a textbook buy and build approach. The second deal we have under letter is a healthcare oriented business, and that's pure de novo growth, right? So we've got a team that's built a box and they've done a great job, and they've got the business to a point. We bring in an operator alongside of us, spent 30 years in the sector, that would help them take the business from, let's call it 20 locations to 60. But that's almost entirely going to be de novo growth. You know, for us, we think there's ways to squeeze additional efficiencies out of the business as you open those new locations. So that's a big part of our underwrite is time to profitability of those de novo locations. And again, that all feeds back into how much equity capital we're budgeting to invest in the business over time.
Definitely. And then if you could kind of elaborate on how you collaborate with your management team post-acquisition, and what are some of the decisions that are made at the board level, some of the key decisions that are made to kind of drive strategy?
Yeah, absolutely. So we're typically establishing the board. For most of these companies, they don't have a board. They're they could be C corps. They're structured really, or sole proprietorship type businesses. They're structured very differently than we look to structure them on the other end of our investment. But there is no board, right? And so we're establishing a board. We're bringing folks from within that industry into play. Again, our model is really built on augmentation versus replacement. There's bigger firms further up market that I think tend to focus on one or two industries or more specialists. They've got very robust networks in a very limited defined window from a sector perspective. More often than not, they want the asset and not necessarily the team. They're looking to replace the team to bring in their own groups. We look to typically augment, again, finance and accounting, sales and marketing where we need to. In the current environment, certainly HR and recruiting, that's an area that's a hot conversation with a lot of management teams right now. How do we recruit better? So anyway, it's more of a partnership driven approach.
Definitely. And before moving on to our last topic, I do want to encourage our viewers to submit questions here in the Q&A, and any question that you would like for our panelists to answer, please like them so we can address the most popular questions before we conclude this. The last topic will be oriented towards Mike here. That will be in regard to manager selection. If you kind of elaborate and educate our viewers on what's your process, what's ACG's process on selecting a manager. Let's start from there.
Yes. So in general, we probably meet with over 200 private equity funds a year. And so we've been doing this for over 25 years. And so we have a system, we have a database where we collect data. We look at track record a lot. I know, oftentimes you get the question, if a manager's top quartile of this fund, should we expect that next fund? And how do you just look at performance overall? And we look at a lot of different asset classes. We look at all investable asset classes. And what we see is on the more efficient asset classes, so large cap equity, even small cap equity, manager, the repeatability of their performance is not as great as it is in private equity. But still within private equity, things change over time. So a manager could have fund one and fund two, be top quartile funds, do a great job. But then often what you see is, fund size increases. And that's normal and that's natural. But it depends on the quantity of the fund size increase. And so you can't just look at their prior two funds and say, well, fund one and fund two were top quartile funds, so we can expect the same out of fund three. Because oftentimes if the fund's bigger, have they added to the team appropriately to source deals, to manage portfolio companies, to sit on all these boards? Do they have the talent to do all that? And so a lot of what we do as well is focus on the qualitative aspects of a fund or a firm. So the first meeting we have with the manager, and typically if a private equity manager has not been through an institutional diligence process, sometimes they're taken a little back, but we want to understand the ownership structure. What are the economics of the firm? Who owns it? Is it one or two key people? Is ownership spread around? And outside of the management company, how's the carried interest allocated? Because more often than not, when firms sort of disband or blow up or whatever you want to call it, probably 7 out of 10 times at least, economics are the driving force behind that. So we're constantly meeting with managers. We're constantly updating their performance. In the current environment, it's a little more challenging because there's been such an appetite for private equity. Funds are being raised in a much quicker time frame, and so whereas 10 years ago a typical buyout fund might raise capital every 3 to 4 years, now it's every 2 to 3 years. And so when you look at their most recent fund performance, a lot of times it's not nearly as mature as what it would have been 5 or 10 years ago. And so you sort of have some incomplete data, and you have to just draw some conclusions, internally. Do we think what they experienced from their funds a couple of years ago, can they repeat that in the future? And so it's a lot of qualitative analysis. Clearly, funds have to have good track records, and it doesn't have to be a fund 5 that had 4 prior funds that we can underwrite. If it's a new spin-out group, we need to have some sort of way to have partner attribution to see who drove the returns at the prior fund, and make sure that that is in line with what their go-forward strategy is going to be.
Mm-hmm. And then do you, quickly before I'm turning into the Q&A, have you seen any relationship between prior performance and future returns?
Yeah, so I touched on that briefly, but I think there is some of that, and so I think if you're a top quartile manager in 2018 in your 2018 fund, there's a better chance that you'll be a top first or second quartile in your next fund, versus if you're in the public equity side, we see the performance. It almost seems like if you're a top quartile manager in a large cap strategy, the next 3-year rolling period, you might be in the bottom quartile. Like that's a lot more what we see, as opposed to private equity. We don't see the consistency that you would like. And because generally if a manager is top quartile consistently, they're going to raise bigger and bigger and bigger funds because they can make a lot of money on the management company. In sometimes, not all the time, but some of the times, as you raise bigger funds, it's going to be harder to generate those level of returns. So there is some consistency in performance. But again, so much can happen in inter fund that we're constantly meeting with them several times a year to understand if there's any changes that would sort of eliminate what our ongoing or ingoing investment thesis was at inception.
Definitely. Thanks much for that overview. And now we will flip it over to Q&A. The first question, I want to encourage our panelists here to kind of jump at the bit here, but it's the most liked one. And it is, we've seen a record number of companies go public over the past 2 years. Combining that with large amount of dry capital on the sidelines, how do you expect deal flow to continue? Casey mentioned reviewing 350 deals to find one deal. How does this compare to prior history?
Yeah, so maybe I'll take that. So how does that compare to historical numbers for us? It's about a 1% hit rate, generally speaking, for our industry, right? You're or below that, right? And there's a lot behind that. That's to close, right? There's plenty of activity between that, right? I mean, we put out 13 IOIs last year, right? And again, in 6 months, right? Our hope is to put 1 to 2 out every month of opportunities that we think are interesting and actionable, right? So it takes a lot of work to kind of down select to that handful that you're getting to. But at the end of the day, yeah, those percentages are gonna, I think, for most groups tend to be really, really low.
Definitely, gotta kiss a lot of frogs.
The question about dry powder is interesting. Casey sent a stat over earlier in the week that there's $3 trillion of dry powder globally in the private equity system. Dry powder just represents capital that's been raised by private equity managers that hasn't been invested yet. And that is a lot. But, I made the point to Casey that a few weeks ago, the market value of Apple was over $3 trillion. And so their dry powder is at an all-time high. If you look at the U.S. dry powder, it's probably closer to 1.8 trillion. But when you think about the market value of publicly traded U.S. companies, it's a little higher than $50 trillion. And so there is a lot of money that needs to be invested. There's also a lot more private companies than there are public companies. And so if you look at the diamond chart that we showed earlier, there's about 160,000 private companies with revenue greater than $10 million. And so there is a lot more capital that needs to be deployed, but there is a huge opportunity. Just the sheer number of private companies massively dwarfs the amount of public companies. And so, it will be an impact. It will impact future returns because just the more money typically you put in something, the lower returns are going to be. But relative to public markets, we still think there's a great opportunity for private equity to outperform.
Definitely. And then kind of relaying that into our second Q&A question here, Mike, how do you feel as if all that dry powder will impact the asset class going forward? And what do you think the impact of new money flow into the space will be effectively?
Yeah, so I think to some extent it will lower returns. I mean, if you look at buyout funds, in the mid 1990s, a median, when there was a lot less money in the space, a median buyout fund, would generate a 25% net IRR. And so if you generated a 24% net IRR, you might think you're great, and your investors might think you did well, but in reality, relative to your peers, you actually underperform. And so going forward, it's likely the amount of capital in the space is likely to lower returns. But again, when you think about investors have to allocate $100 of their portfolio. You can sit in cash, you can sit in fixed income, you can spread it around. If you're looking for ways to generate incremental return in your portfolio, we still think, for all the reasons we've touched on, prior, just the opportunity set, some of the value creation levers that Casey touched on with what his firm does. We still think there's going to be an opportunity to generate outperformance in private markets relative to public equities.
Mm-hmm. And then the last Q&A question here, it's for Mike again. The question is, net returns for a growth buyout are less than 5% better than the S&P 500 for a 3, 5, 10, and 15-year time horizon. Given the leverage and the illiquidity in private equity, is it safe to say that the asset class underperformed public markets on a risk-adjusted basis? Yeah,
and it's funny. We talk about this a lot with clients. So, in the rearview mirror, the best thing to do is just buy all large cap U.S. equities, and not only just large cap U.S. equities, buy the top 5 tech stocks. That over the last decade, that would have been the winning strategy. And so when you look at, Patricia touched on private market valuation, multiples are going up. Public market PE multiples are extremely high as well. And so, this kind of takes me back to a comment that, one of my colleagues who was managing money in the late 90s, he managed a value strategy, and, they just had a terrible time because all these growth funds were just generating, 50, 60% returns annually for years. And it was a tough sell for his investors. But eventually the tide will turn. Eventually, you saw Facebook drop 20%. Eventually some of these publicly traded tech stocks that have done so well, we don't think the trees grow to the sky. And although private equity has not kept up with public equity for the last decade, where we sit today, we're focused on how can we add value going forward. And so, we really think pretty strongly that, private equity can generate some outperformance versus public equities going forward.
Yeah, the only thing I'd add, Christian, to Mike's point, that return metric that we're showing for private markets probably is the median return, I would bet, Mike, right?
Correct. So if you invest with Casey's firm, you're going to get substantially higher returns than that.
That's right. I was going to put that back on you. I said this is why you pay guys like Mike the big bucks, because you're trying to get to the top quartile return, right? The delta between the top quartile and the median in these different sub asset classes. I mean, talk about venture capital. That could be 20% difference between the median and the top quartile return. So this is definitely a segment of the market where it pays to have good advisors getting you into really good access with the top performing managers. Mm-hmm.
Well, that is it. It is 6 o'clock, and I want to thank all of our viewers, and thank you to definitely our panelists, Mike, Patricia, Casey, for joining us today, and to all those that also attended and this event. And at the end of the event, you will see a notice to complete a survey about today's event. Your feedback is appreciated and helps the CFA Society Chicago when planning future events. If you have any questions about today's event, please contact the CFA Society Chicago office at info@cfachicago.org. Thank you very much, and looking forward to seeing you guys next time.
Thanks, everyone.
Everyone.